Hello, I'm Miyun from the Department of American Cuisine. Let's start today's United States stock news for May 12th. Today as well, I'm Miyun, who is keeping the integrity of United States stock investment without change. I have something to say before we start. As a father of 2 children, I always tell my kids that it's important not just to get a job, but to have a dream. There are 2 types of jobs. One is an entertainer and the other is an athlete. The reason I hope our children don't become entertainers or athletes is because I have some concerns about those careers. Both professions have things in common, and of course there are differences depending on the case, but most entertainers or athletes are like this. Usually they reach their prime in their teens or 20s. We're now living in the 21st century, but it's a bit odd to set the peak of someone's life so early. But now I still have about 50 years left to live. The most important thing in life is to keep growing, to keep evolving, and to do things that make my life meaningful. So instead of thinking about how much time I have left or how long I have lived, I believe the most important thing is to live today, even just a little bit better than yesterday, and to focus on living a happy life. That's what I consider the most important element. So for example, our children might become athletes or entertainers. In your early 20s and even in your mid to late 20s, you still have pimples. And then, how hard must it be for them to keep living their lives in a constant state of anxiety or to keep changing? If you look at it that way, it seems like they're living a life with almost no hope, and that's why they're constantly anxious. So I keep telling my children and my daughter not to become athletes or entertainers, and I keep emphasizing this message directly. Anyway, I hope our children will stay away from these kinds of professions. We are all investing in United States stocks through a community called Mizone, and I also consider myself an investor. Right now, rather than how many % returns I can make in a month, what's more important is this. In the end, what's most important is whether the assets I own can continue to grow year after year, over 5 years, 10 years, 5 years, 20 years into the future. That's what I believe matters most. Honestly, even if right now among those watching this broadcast, most of you are probably in your 90s or 80s, so it's natural to focus on immediate returns. But let's say some of you are in your 70s, 60s, 50s, or even younger, 40s or 30s. If you're an investor in those age groups, then over the next 10, 20, or 30 years, you'll continue investing. So today, this week, next month, and even the returns from the past year, I'm wondering if those short-term results are really that important. What's important is this. What's important is that as we continue to invest and build experience, when we look back later, we should pursue a more effective track record. So my income keeps increasing little by little every year, and after the next 5 years, then another 5 years, and then another 5 years after that. If we can achieve slightly better returns as investors, shouldn't we ultimately set higher goals for ourselves? That's my mindset. So with that in mind, today, together with Mi-jung, we'll look back on the experiences of investing in United States stocks, and once again, I'd like to thank everyone and share a few words of encouragement. I'll share all the experiences I have so that everyone can become even better investors, even if just a little bit. I'll do my best to help you as much as I can. Now, let's get started with today's Big 2 news recorded on May 10th. Today on the broadcast, there's a reason why I started with such a light greeting in the intro. Before discussing today's main topic, Sun Moon Jisoo is in a bad mood. Dow Jones futures are currently up by about 2.27%. S&P 500 futures are up by 2.87%, and the Nasdaq futures, which we are watching closely, are showing a remarkable surge of about 3.77%. Now, let's take a quick look at how the S&P 500 has been performing up to this point. Here was the lowest point. That was on April 8th. On April 8th, the lowest point was 4,835. The S&P 500 has now reached a closing price of 5,820. So, if you look at it, from the lowest point to now, the index has risen by about 20% in a very short period of time. In just 1 month, it went up by 20%, so you could say it's a rapid rally. Yes, that's right. To benefit from a sharp upward trend, it's crucial to have a flexible mindset and to have invested before the rally started. This is the key takeaway. As I mentioned earlier, many investors who anticipated this upward trend in advance are also making profits now. On the other hand, among investors who haven't invested yet, some are joining in with me to overcome this difficult market situation, and others are making additional purchases at the current high prices, hoping for good returns. There are also those who are still waiting and watching. So, we went back a month and looked at what happened then, and we also thought about what we should have done at that time, and how it would have been better if we had made those decisions. The first article was one that I shared with many of you on April 7th. The title was, "It Won't Be Different This Time Either." Let me read it for you. In an environment where we can't predict the future, what investors can rely on is their own discipline and historical statistics. You have to trust one of the two, and that's how you can overcome the message. But personally, rather than relying on my own emotions or intuition, I prefer to invest based on historical statistics and data. The reason is that doing it this way increases the probability of success. And then, since my birthday is April 7th, April 8th, was the very next day, right after it was just the day after my birthday. I shared the historical facts of these two cases with several people at that time. The first is that, except for this time, there have only been 4 instances in the history of the United States stock market since 1950, where the S&P 500 dropped more than 45% consecutively. Many were surprised at the time. On April 3rd and April 4th, the S&P 500 dropped 4.8% for 2 straight days, plunging over 6% on one day. During this time, it fell more than 10%. But the question is, after such a drastic drop, what happened to the market in the following 12 months? The United States stock market recovered 100% of the time, and the average return was an impressive 34.3%. The median return during this recovery period was also 33.9%. So, on April 3rd and April 4th, after such a historical crash, the next thing to do was to buy stocks without hesitation. This was a pattern we could observe from historical statistics. But that's not all. There was something more. That's not all. There was one more thing. Among the 500 major companies included in the S&P 500 index at that time, the proportion of stocks trading above their 200-day moving average did not exceed 23%. Historically, that's an incredibly low figure. If you look here, since 1990, there have only been a few cases where the percentage of stocks in the S&P 500 trading above the 200-day moving average has fallen below 25%. After 12 months, there was a 77% probability that the United States stock market would rise, and the average increase was 14.5%. And if you look separately at just the statistics from the most recent 10 years in the same situation, the probability that the United States stock market would be up after 12 months was actually 100%. That's why I'm not going to do anything different this time either. You have to be patient. You can't panic. And this is the message that many people shared on April 7th. And there was something else on April 7th. Despite the United States stock market rebound, that's not the key point. I shared articles about this with multiple people. Now, let's review Min's chart. When the stock market fluctuates like this, it's easy to get nervous and think the market will keep falling. But we need to remember that the market has gone through similar periods before and recovered. If we panic, that's not good. I wanted to share this message with you. At that time, based on my own experience and memory, I realized that the stock market's rebound usually begins when it seems almost impossible for it to recover. I wanted to share my experience with you. Even back then, the turnaround always started when it seemed least likely. At the time, people said that since Trump's tariffs were just beginning, the bottom was still far away. But in the middle of that, the rebound started. It was always when it seemed logically impossible that things turned around. So this time, it looks like the downtrend will continue for at least another 6 months. That's why people think it's reasonable to sell everything now and come back in after 6 months when things have settled down. This kind of rational and logical calculation and planning always ends up betraying investors. It's because of overconfidence. Selling your stocks may seem logical, but it usually doesn't work out. That's the message I want to deliver to you. Now, and one more thing. At that time, the dividend yield of Bings was only between 50 and 93%, but it dropped below 45. So I shared this fact back then. Since 1990 until now, VIX has only exceeded 45 twice. The first time was during the 2008 global financial crisis, and the other time was during the pandemic. That's why we have to respond rationally, control our emotions, and make decisions. The situation when Timothy Geithner was writing stress tests during the 2008 Lehman Brothers crisis and the situation when people were dying during the pandemic in 2020 both required us to make rational judgments. So even when I look back a year after that time, I realize that my decision to hold on to my stocks wasn't wrong. I'm telling you this with confidence. So even today, I'm enduring a difficult time. This isn't my first time, and I'm sharing this message with you again. And on April 8th, the day right after that, that's when the United States stock market, which is watched by investors, opens. This article has been shared by many people, and there is a reason for that. In the end, the historical fact that this article tells us is important. After the VIX index exceeded 40, there was always a political or economic policy change that followed. And so, the stock market was directly affected, and whenever it went over 40, the United States stock market was hit directly. This is a historical fact that many people have talked about. And then, in 2025, there are two political changes that we can expect. One is the Trump administration, and the other is the continuation of the current administration, the Trump administration. For the stock market, expect a Trump administration news push. From the Fed, anticipate a looser monetary policy than predicted. Even though the United States economy and stock market are at their lowest, they are recovering and rebounding without any major shocks, thanks to these political changes. It won't be any different this time. I will share the same message with you several times again, and I will continue to share it. And so this article was written after April 11th. During the financial crisis, the United States Treasury intervened to support the stock market. Now, an article suggests selling stocks, but I personally disagree with its content, as I have already shared my thoughts on this matter. The author of this article is basically criticizing President Trump, and this is just my personal opinion. That's what I said. What does this mean? What this means is that the ideological issues between President Trump and the Republican Party and the situation of division are not simply caused by a few extreme or radical individuals, but rather, this kind of thinking is widely shared. So if you look at the process and history up to now, whether they were Republicans or Democrats, all politicians have always tried their best to maintain their support base and to appeal to their supporters, and this time will be no different. I'm saying this because there's a general election next year in the United States, so they'll try to maintain the status quo. That's my point. So today, as the United States stock market has surged, the S&P 500 has risen from 5,025 on April 9th to 5,825 as of May 12th. In just over a month, we've seen an incredible situation where it has jumped by more than 20%. Looking ahead, it's hard to predict how the United States stock market will move. However, our decision not to enter the United States stock market a month ago was the right choice. And later, we can look for another good opportunity and adjust our strategy again. When that time comes, I want to share with you that it's important for us to stay calm and remember the experiences we've had. Today is Monday. I'll start by reviewing last week's United States stock market situation. I've been watching the S&P 500's trend on a weekly basis, as you can see on the chart. So you can see both red and green candles alternating, showing a mixed trend. It's hard for us to predict the direction of the market. Overall, semiconductor stocks perform very well, while on the other hand, if you look at companies like Apple or Google, you can see that their performance was relatively weak. So you can see that even within tech stocks, there was a mixed trend like this. If you look at the performance of the indices last week, the S&P and the Nasdaq went up by 0.57% and 0.49% respectively, showing the best performance. The Dow Jones, Nasdaq 100 and S&P 500 all fell by 0.15%, 0.18% and 0.43% respectively, indicating weak overall performance. So you can see that while some sectors went up and others went down, there weren't many big changes overall. Many market sentiment indicators have greatly improved. Currently, the market volatility index has fallen to 16.83. Now, among the 500 companies that make up the S&P 500, more than 60% are momentum-driven industries. This part is much more positive than before, so valuations are possible like this. The second point is that the earnings index is also performing well. As shown, many stocks and companies are displaying positive earnings and dividend indexes. If the VIX stays below 20 or 13 for a while, it means the VIX is getting lower, and when the 201 moving average, it indicates that the market is stable, the upward trend is strengthening, and this is how we can interpret it. The fear and greed index has also been falling to the greed range lately, but it went up to 62. Now, greed is getting a little stronger. We still need to keep an eye on the market for a while to see if this trend continues. So, during the period when the market was quiet, we could see that the sentiment in the market had improved significantly. The market score for the choice star period is also gradually increasing step by step. If we enter the greed stage, rather than chasing after greed, we need to interpret the market like this. So, seeing the market score rise this quickly is a rare phenomenon, and that's what I wanted to tell you. Let me read it to you again. If the market score comes up due to greed, it's a dangerous sign for the market. It's a time to watch for the potential movement of highly valued assets, and that's how the market is giving us a warning right now. Let me read it to you again slowly. On April 9th, it dropped to match the market's low point for the first time, based on the supply-demand level, and did not touch that level again afterward. And if the market demand continues to rise, you can see that it has repeatedly returned to the supply-demand level in a very short period of time. Now let's take a look at the performance of meme tokens. Also, out of 20 meme tokens, 18 have dropped. I removed 2 items. The first one is Google, and the second one is InnoData. Let me explain why I removed these 2 items. Currently, in several selections, there are some stocks that have shown an unusually sharp rise. For example, Trade Desk is up by 5.77% in the futures market, and it's going up sharply. AMD, Tesla, Broadcom, and Nvidia futures are all up over 5%, with Tesla leading at 7.78%. The market is showing a robust upward trend. 7.90%, 6.98%, and 11.28%. So with semiconductor stocks soaring like this, what about Google and other internet-related stocks? The sharp upward trend is largely due to the earnings announcements that came out last week. They're not even going up more than about 3%. So in order to ride this lukewarm upward trend, I think it's wiser to put your investment funds into sectors without any bad news, rather than those with bad news. If you know this well, in cases like Apple's device-related keywords, recently, Google's search traffic for Apple's device-related keywords has been declining. So you need to be careful about this. So you could say that the outlook for Handong has improved significantly. InnoData announced its earnings last week, and the earnings results were very good, but the guidance was too weak. So a lot of disappointed investors have been showing up. This earnings season, there are too many stocks with good prospects. Trade Desk and AMD are like that too. Currently, there are many stocks with stronger earnings results than expected. However, I personally think there's no need to invest your money in stocks with weak earnings results. If you look at the stocks that performed the best last week, Trade Desk surged by about 31 to 34% in just 1 week. B2 plus rose 12.34%, Nextracker plus 10.28%, and 10.2% with the number of coins reaching 1,044,000. Strategy also soared by 5.49%, 5.26%, AMD 4.09%, Tesla 3.85%, Broadcom 2.24%, Nvidia 1.88%, and Amazon 1.62%. On the other hand, 7 stocks fell. Talon Energy dropped by 0.35%. Meta was down 0.76%. Celestica was down 1.08%. Taiwan Semiconductor Manufacturing Company was down 1.54%. Uber was down 1.74%. Vista Corporation was down 2.53%. And finally, Palantir fell the most with a drop of 5.62%. Next, I should explain the reasons why the United States stock market indexes are showing this trend. I was preparing for the broadcast when this breaking news started coming in, one after another, just as I was about to start recording. The United States and China have agreed to raise tariffs on each other by 115%. Such shocking news would likely cause a dramatic upward trend in United States stock market futures. The United States and China have agreed to temporarily suspend most of the tariffs imposed on each other's goods for 90 days, and they have also agreed to significantly lower the mutual tariff rates. This means that the prolonged trade war between the world's 2 largest economies has partially eased. That's how you can interpret it. Let's hear how Janet Yellen, the United States Treasury Secretary, responded. We agreed to a temporary suspension of tariffs for 90 days and decided to actively negotiate tariff rates. Regarding mutual tariffs, both sides have agreed to maintain the current 115% point rate for now. The news that arrived was unexpected. The Trump administration has imposed a 145% tariff on some Chinese products. And in response, China has imposed a 125% tariff on some American products. But the United Kingdom, starting from May 14th, will also impose tariffs. The United States has agreed to lower tariffs on Chinese products from 145% to 30%, and China has agreed to temporarily lower tariffs on American imports from 125% to 10%. And what about the United Kingdom? And not only that, but the two countries also agreed to continue cooperating on economic and trade policies moving forward. Our stock market is performing well. Now let's conclude with Han Madero's closing remarks. This agreement is very positive for the stock market sentiment. The United States stock market rally continues as the S&P 500 index rises for the third time, showing a strong upward trend. It is very likely to surpass the 5,700 point mark. Technically, the momentum is very good because the story is showing strong momentum right now. The market's atmosphere is in a strong upward trend, as can be seen when examining it closely. Now let's focus on the commodity market. Compared to the actual announcement, the market reacted more positively, and after April 8, the price continued to rise. This announcement may cause the market to reflect expectations of a United States economic recession, potentially leading to a decline. That means money that was tied up in safe assets like gold or bonds could be redistributed into riskier assets again. So, in other words, as the probability of a recession dropped sharply, the money that had moved to the sidelines could come back in. And there was also another good sign. Furthermore, the dollar index is also rising, climbing up to 101.42. This part is said to have a lot of content that creates a sense of sharing on YouTube, and if the United States government takes action, it will be good news for Korea. There are many contents that naturally create a sense of sharing like this. This time, the Bank of Korea and the Ministry of Strategy and Finance agreed, and the Bank of Korea announced there was no discussion or process regarding currency intervention. Let's examine the details closely. This statement was released immediately following the United States trade negotiations. So right now, there are a lot of expectations that the current administration is pursuing a strong dollar policy. Therefore, as the dollar strengthens, it is having a positive effect on the United States stock market. Well, this time, the start of the week is really great. So, we need to keep following the United States stock market news to see if this upward trend can continue for a while. The next prepared article is about the United States stock market. Earlier, I briefly mentioned that the upward trend in the United States stock market is technically positive, so let me elaborate on that now. It seems like this is related to what I just mentioned. Many people might have heard of the term P/E ratio. I've explained this several times on my personal broadcast as well, but I think it would be good to take this opportunity to thoroughly master the Fibonacci ratio. There's a question about whether the recent rebound in the S&P 500 index is a real upward trend or just a temporary bear market bounce. There's a rumor that he's getting married. Some people say that the S&P 500 has now fully entered an upward trend, and there are also many people who think this way. On the other hand, some people say that it's just a temporary bear market bounce and that it will fall again soon. There are also quite a few people who present this kind of perspective. And these questions naturally arise when the market falls sharply and investors become more cautious. Especially since the United States-China trade negotiations started on Saturday, economic uncertainty has remained quite high, so caution is growing. In such situations, it's crucial to analyze things technically to improve the chances of investment success. That's how you can make promises now. The S&P 500 dropped about 18.9% from its all-time high of 6,144.15 on February 19th to 4,982.77 on April 9th. As many know, a bear market is officially defined as a decline of 20% or more. It briefly returned to a bear market, but fortunately did not remain there for long. I recorded the activity with a bit of humor. The S&P 500 index rebounded by 13.6% from its low point, based on Friday's closing price. And this is enough to make investors wonder if a new upward trend has begun. So, if you look at the technical analysis in this context, it seems like a good sign. Usually, chart analysts use mathematical and natural principles to find answers to these questions. When discussing mathematical principles, the 13th century Italian mathematician Fibonacci is often mentioned. He based his discoveries on a sequence of numbers. This sequence goes like this. You add the two previous numbers together to get the next number. So it goes 1, then another 1, and then you add 1 and 1 to get 2. To get the next number, add the previous two numbers in the sequence. 1 plus 2 equals 3, 2 plus 3 equals 5, and so on. That's how the sequence works. But there's one interesting part about it. As this sequence gets longer, the ratio between two consecutive numbers approaches 0.618. For example, if you divide 13 by 21, you get 0.618. Fibonacci numbers appear in nature, such as in the arrangement of petals, spiral patterns of pine cones, shells, and even the human body, showing the golden ratio's prevalence in natural systems. 0.618 is considered a mysterious and natural number, hence its name. Therefore, even in the stock market, people who participate in the financial market see it as a collective body, and they believe that the laws of nature are also applied to the market. That's why they make such assumptions. Therefore, there are many cases where people use the Fibonacci ratio as an analysis indicator. To explain it again, if the rebound after a decline goes beyond 61.8% of the previous decline, it is seen as not being subject to further downward pressure. The next step after a decline is that if the rebound exceeds 61.8% of the decline, it's no longer considered a downtrend but an uptrend. That's how it can be defined. And the next point is that the price completely recovers to the level before the decline. If the price rebounds 61.8% from the low, the next target is 100% or reaching the previous high, which acts as the next resistance level. Now then, what about the case of the S&P 500 right now? The drop from April 9th to the recent low was 1,161.38 points. If we apply a 61.8% retracement from that point, the index base would be 5,700. So if we recover 61.8% from the recent low, it goes straight to 5,700. That's how you should look at it. Is Fibonacci retracement reliable? In uncertain times, it helps to suggest resistance and support levels. Why is that? When prices fall, there's a high chance of a rebound at the 61.8% level. However, during sharp price increases, the 61.8% level often acts as strong resistance. To draw a strong resistance line, look at it this way and you'll see. But on May 2nd, there was a record of hitting 5,770 in the middle of the market. However, when the candle closed, it fell back down to 5,686. And last Thursday, during the day, it went up to 5,720, but when it closed, it dropped back down to 5,663. Then on Friday, it continued to rise and showed a good trend, but the closing price was 5,659. During the session, it reached 5,691, so it almost touched 5,700, but then it fell back again. This happened 3 times. It hit 5,700 and then dropped back down. That's how it looked. Yes, just like this. All the evidence shows that the index is stuck in a very simple bounce phase, and it's hard to see this as a fundamental upward reversal. Technical analysts view the inability to break through 5,700 as a sign of a continuing downward trend, considering the current movement a rebound rather than a genuine reversal. If the S&P 500 rises about 0.7% today and breaks through 5,700, that's very important. That's how you should look at it. If the price falls soon after a breakout, it may be a false breakout. The Fibonacci retracement levels you can pay attention to are the 50% level, which is 5,563, and if it falls further, the 38.2% level, which is 5,426. Now you might wonder how the 38.2% level comes out. If you subtract the 61.8% level, which was previously marked, from 100, you get 38.2%. That's how you get this number. Now this time, let's take a look at the tag stocks. A technology-focused exchange-traded fund is coming out. XLK is the ticker name. So what is XLK? 61.8%, 218.3. I will skip this part briefly. From a technical standpoint, it couldn't sustain the level and kept getting stuck at 61.8%. That's what's happening when viewed this way. On Friday, the closing price was held at 217.60. On the other hand, what about a different exchange-traded fund like XLY, which tracks consumer discretionary stocks? The return up to now is less than 41% of the lower part. Therefore, the reason why technology stocks have risen so much is actually true. The recovery of other major indices, such as the Dow Jones Industrial Average, has also been slow, with only 48.9% of its decline recovered since the recent peak. Historically, you have to surpass the 50% mark, and then you can go up to 61.8%. That's how you should look at it. The National Association of Securities Dealers Automated Quotations. Composite index has recovered 54.2%. To reach the 61.8% target, it needs to rise an additional 2.1% to 18,299.8. That's how you should view it. Now, by the way, the current stock market is showing a mixed trend. So if you look at it technically, you can see that there are a lot of conflicting signals. The S&P 500 has already surpassed not 5,700, but 5,820. Nasdaq's index also rose up to 28,000. The leading indicators have already recovered 61.8% of the pre-correction decline and have risen further. So today, both the S&P 500 and the Nasdaq index continued their strong upward trend. Based on technical analysis, we can now confirm the market has fully reversed to an upward trend. Definitively stating that it has surpassed 61.8% and is now an upward reversal is difficult. Even though we've seen this kind of recovery, as long as it continues for a few more days, we can feel more reassured that the downtrend is over. Now, as we've seen earlier, there is positive news coming out regarding the Trump trial. From a technical analysis viewpoint, the United States stock market outlook appears quite positive. Therefore, the momentum itself has shifted upward, so we can have positive expectations. I'm just saying this repeatedly, but momentum is important. When a short-term catalyst appears, you can catch it. So in order to maintain this upward trend in the short term, a positive catalyst is needed. That's how you should look at it. Now, in that sense, I'll organize the events with the most direct and powerful catalysts that are scheduled for this week, so that you can keep them in mind and pay attention. Now, first of all, Wednesday is important. On May 13th, an economic indicator will be announced. It will be released at 7:30, so you should keep an eye on it at that time. In the United States, the Bureau of Labor Statistics will announce the Consumer Price Index for April. The Consumer Price Index is currently extremely important in the market. Inflation is expected to slow down due to the impact of interest rates, leading to many concerns and expectations. If inflation rises, cutting interest rates becomes challenging. The Fed must first reduce inflation to sustain rate cuts and support further United States stock market growth. Therefore, keeping consumer prices in check is crucial. That's one perspective. The market's outlook is expected to rise 0.3% compared to the previous month and increase 2.3% compared to the same period last year. And excluding the volatile food and energy sectors, if we look at the so-called core consumer price index, it's expected to rise by 2.8% compared to last year. So with these numbers, as long as we don't see a lot of unexpected changes, the current momentum of disinflation can continue. That's how it looks right now. Next, on Thursday, May 15th, there are two events that we should pay attention to. The first is the United States Retail Sales Report, which we also call the retail sales figures. It will be released at 8:30, and for April's retail sales, the current market consensus is a 0.1% increase compared to the previous month. So, compared to last month, retail sales are expected to rise slightly. This is the current forecast. So, if this turns out to be better than expected, it could ease concerns about an economic slowdown. So, this is also an important economic indicator that we, as investors, need to pay attention to. That's how you should look at it. And at 8:40, the unemployment claims will be announced. In this announcement as well, if the unemployment claims show a possible increase rather than a hopeful result, it could signal a slowdown in the United States job market. That's how you should look at it. Finally, the Consumer Sentiment Index will be released on Friday during United States trading hours at 10 anti-meridian. The market consensus is that the preliminary Michigan Consumer Sentiment Index for May will be recorded at 53. If that's the case, it would be slightly lower than April's final figure of 52.2, so that's what the market is currently expecting. If this figure turns out to be lower than expected again, there is a possibility that the market could fluctuate a bit. So although the current momentum is strong, depending on how these new pieces of news are received, the momentum of the United States stock market could either slow down or, on the contrary, become even stronger. It's important to confirm this point. Today, at the end of the day, the news that was delivered was read by an artificial intelligence that only reads headlines. And if you look at the article titles, they are all very vague or just one-line summaries. That's how they were listed. For example, is it a good sign or a bad sign? They just show you one graph, and it's hard to tell. Right now, the graphs they're showing are mostly about the trend, and they're just showing the direction. Compared to drug prices in the United States, you can see how low the drug prices are in other countries right now. For example, if you compare the average drug prices around the world, the price of medicine in the United States is 278% higher, and compared to France, it's 326% higher than in the United States. So this is how incredibly expensive medicine is in the United States compared to other countries. In this context, a large-scale drug that doesn't require a prescription has emerged in the current market. This is what you're seeing here. For more details, please replay the artificial intelligence and summarize content. Today's broadcast ends here. Thank you for being with me from the first to the last broadcast of this new week. There is still a lot of big and small news left for this week. Let's stay healthy and strong together with the United States and China. I hope United States stock market investors have a successful week ahead. Let's keep fighting together as we all work toward financial independence through investing in United States stocks. Have a happy day. Thank you. Washington, May 11th, Reuters. President Joe Biden said on Sunday that he will announce an executive order as early as this week aimed at addressing the issue of different countries undercutting United States prices. He said the new prices would be 30% to 80% lower than current prices. President Trump said he would sign an executive order on Monday requiring social media platforms to regulate prices at the lowest level among major countries or to implement international reference pricing. The United States pays the highest cost in the world for many prescription drugs, sometimes 3 times more than other advanced countries. President Trump said he would solve this price gap, but did not disclose specific methods or detailed plans. Now, as prices rise globally, the fairness of the United States is being questioned for the first time in years. I will make sure that the United States maintains the lowest prices in the world and also ensures the same prices as other countries, President Trump said. The White House expects pharmaceutical companies to comply with the administration's program to reduce prescription drug costs for seniors, according to 4 industry executives who were briefed by the White House. Reuters reports that such policies are under review, but nothing has been finalized. The industry believes this executive order follows the Inflation Reduction Act signed by former President Joe Biden. Current negotiations target 10 drugs, but more are expected to be included in the future. Under the Inflation Reduction Act, Medicare negotiated the prices of these 10 drugs, and these prices are expected to take effect next year. More drugs to be negotiated will likely be determined later in the year. Alex Schreiber, a spokesperson for PHRMA, the largest lobbying group for the United States pharmaceutical industry, said that the administration's plan to set prices through executive order is harmful to American patients. This is not the first time President Trump has tried to link drug prices to those in other countries. In his first term, he attempted to implement an international reference pricing system, but it was blocked in court. At the time, the administration expected to save more than $85 billion over 7 years, and this would have reduced prescription drug payments by more than $40 billion during that period. Hanmadi of the United States. According to research and analysis by Feldstreiss, who is with me, the actual price of American medicine is 278% higher than the global average, 326% higher than in France, and 347% higher than in Japan. And as of March 2025, according to the United States Consumer Price Index Inflation Index, the rate of increase in drug prices is about 1.35% lower than the overall inflation rate. If drug prices could be lowered by 80%, according to the Trump administration's proposal, the annual consumer price index inflation rate could drop by about 1 percentage point. This is scenario. While it's highly unlikely that all drug prices could drop by 80%, if even a portion of these prices, which have a significant impact on the consumer price index, could be lowered, it could help curb the rapid rise in inflation in the United States in the future. Thank you.